Good morning, everyone. How are you guys doing today? It is Wednesday, March 25th. Hold on one second here while I get you my monitor. My name is Eric Senft. I'm going to be your host for the next hour and a half or so. Welcome to our DTS trading room, our open house. DTS stands for Diversified Trading System, and it's diversified because we're looking at the market from 3 different points of view. Here in the top left, the tool you see is the Hawk Micro Scalper. It's designed to pick up short-term market swings and market signals. Here on the top right is the Falcon Swing Trader, and as the name suggests, that one is designed to pick up swing trades. The bottom left here we have the Eagle Trend Trader, and the bottom right is the latest addition to the DTS family. It is the Raptor. The Raptor is essentially a blend of the other 3 tools. So it has elements of the Hawk, elements of the Falcon, and the Eagle, all smushed into one, so to speak. The charts you see here on this monitor are the NASDAQ, and I've also got soybeans and crude oil on my other monitor. Just a quick refresher. It looks like some of you, the video wasn't coming through just yet. So here, the top left, this is the Hawk Scalper. Top right is the Falcon Swing Trader. Bottom left is the Eagle Trend Trader. Bottom right is the Raptor. And we just had the opening bell. The market's still a little bit choppy. It did fall off yesterday, finally, as we were hoping it would. This is the Falcon Swing Trader. Let's take a look and see what's been going on in the overnight. Not a whole lot. Yuck. Oh, I was really hoping the market would shake up a little bit. We have seen so much choppiness the last few days. So here was yesterday's session. We kind of stuck it out for the morning. It's kind of a carbon copy of today, isn't it? Kind of saw a little bit of this, a little bit of a run to the upside, and then they tipped over and started heading lower. Had a little bit of a delayed trend change signal here with the Falcon. With the trend change signal, we're essentially looking for the trend line to change color and for the first signal to come into sync. Now, the tools always generate signals the same way, regardless of which tool you're looking at. We're always going to get a warning dot to tell us a trade is developing, and then we get a triangle and a hash mark to tell us the signal is complete. So here we had what we call a late filter entry, which is when the trend line does not go out of sync. So the trend line stays red. The filter goes out of sync, comes back into sync. That is a very powerful signal, and you can see we had a little bit of follow through on that one. But where we're at right now, what a mess. I'm not sure we're going to see anything worth trading so long as the market stays within this range. But I can always show you some things. These lines, these extra lines you see on here, by the way, these are our support and resistance suite. This is actually an add-on indicator. You can use this on any chart, not just DTS, but you can see we've got a series of lines. The gold line here is our median line, and then we have primary resistance and primary support above and below. And you can see this is exactly where the market is hovering, right between those 2 lines. The median line pretty much skewers it. So we'll leave that alone for now. It is just 3 or 4 minutes into the session, so we're going to try not to get too excited. I suspect if I were a betting man, we will see the NQ decline today. Oh, it looks like we're working toward the bottom end of this trading range. Actually just got a good signal here on the Eagle. This is our green bar sell. We'll see if that comes back and gives me another signal. If not, I might be able to pick it up on the hawk. I was looking for an opportunity to short today. Oh, there they go. Come back here now. So they're at the bottom end of the trading range. This is our hawk scalper. And you can see same sort of mess, a lot of yellow bars through here. That's telling us we've got a pretty choppy market to play with. And now that we've broken the support, we hopefully will see a little bit of a reaction here. And give us another opportunity to get into this trade. Come on now. Play nice. This is our Raptor. The Raptor fired a signal here just coming out of the band. Same thing with the Eagle. It borrows this trading band from the Eagle. It gives us, or helps gives us, our directional bias. And what was important here is this little failure. We really like to see this type of setup. We call this a test of the extreme being the high right here. Some of you will recognize this as a head and shoulders type formation. The concept is the same. All right, well, a little bit of a decline there. The hazard of moderating a trading room, sometimes you end up missing some signals when you're looking at other things. This green bar sell, this is here on our Eagle tool. This is a question that people often ask about DTS. They say, well, what about all these arrows here? Do you take all these signals? And the answer is no, we don't take all those signals. What we do is we hold out for the better signals. And with the Eagle, one of the better signals that we like to see is this guy right here. The green bar sell in a downtrend. Or if our band is turned the other way, let's see if I can find you one. Here we go. The red bar buy. Now these signals tend to originate near the hard edge of the band. And you can see they're high probability signals, so we tend to focus on those types of signals. That's not to say that we won't entertain well, here's another one of our signals. It's the first trend change signal, so the band flips over and we generate a signal which is all in sync. Right? Notice the bars are red, the filter is red, the band is red, everything is in sync there. This is also a high probability signal. It's our trend change signal on the Eagle. But the red bar buys and the green bar sells tend to be very reliable signals when you have an established trend. So unfortunately that one developed while I was looking elsewhere. Oh, doggone it. This one's going to run away on me too. Here we're getting a first micro-macro cross signal on the hawk, which tends to be a very reliable signal with the hawk tool. And doggone it if that thing isn't running away on me too. I was waiting for this. So the hawk signal, the first micro-macro cross, this is one of our high probability signals. Hopefully somebody got it, someone in the room. What we're looking for is our micro line crosses our macro line. This is the first signal where everything is in sync. Generally, we'd like to see this signal generate a little bit earlier. Like it should have printed somewhere around there. But we didn't get any hesitation until right here. Now, because it's come down such a long way already, honestly, I would not have risked it here to the stop strategy that we have employed. I would probably risk it at least above this old support area. I'd probably even try to risk it back to the macro line. Let's see, did it hit our high probability target? Yes, it did. And then it starts to reverse. Happens quite a bit. You'll find that the market will hit your high probability target and then reverse. Here's a first micro-macro cross to the upside. Did that one reach our high probability target? Yep, hits the target, and then a couple bars later starts to reverse. This may well turn into a macro pullback yet. So that will be the next signal I'm looking for, or a 4-arrow consolidation. We should have another chance at that one. Here with the Falcon, you can see, pardon me, we had the early trend change signal up here, just off the market open. And what distinguishes the early trend change signal from the normal signal is that the signal produces just as the trend line changes color, but it has this telltale test to the extreme, this down, up, down pattern. Here's a proper trend change signal. This one, we have the move that changes the trend line color. The market comes back against us, generates a signal, and we get the order, the hash mark, somewhere near the top of the formation, or in this case, the bottom of the formation. All right, so the Falcon working here on a warning dot. Brent is asking, are these normal tick charts on Ninja? No, Brent, they're not. These are using the mean Renko bars from Indicator Warehouse. And you know what, folks? I totally forgot to get you some of this information. Hold on a second here. I'm going to get you. The mean Renko bars are, they're actually pretty cool. They're a blend of range bars and candlesticks. So they have, you're really getting the best of both worlds. There you go. I'll send everybody that information. Now the thing with that I really like about the mean Renko bars is how they show you the price activity, who is in control of the market. It's very easy to see, you know, that we had the sellers take control right here, right? It's pretty obvious. Here we can see a little bit of a struggle. The buyers are forcing the market a little bit higher. I suspect we'll get, oh, stop that. I suspect we'll get somewhere up here. We're currently generating a macro pullback signal. Well, for the moment anyways. It's not complete just yet. The bar keeps waffling. The macro pullback signal, another one of our high probability signals, it occurs when the micro line goes out of sync, but everything else stays in sync. I wonder if that one actually got low enough to hit the target also. Yeah, it did too. Look at that. Okay, and here in the Falcon, we had our delayed trend change signal, and that one is slowly making its way down to its profit objective. There we go. So a pretty good day so far right out of the gate. David's asking about seeing crude oil on the Raptor. Absolutely, David. Hold on one second. I will pull that up for you. Wow, tremendous day in the NQ today. Much better than what we have been seeing. All right, one second here while I get you crude oil. The Dow also in a tailspin. It wasn't really a surprise that we were going to see the stock index head lower today, I don't think. All right, here comes crude oil on the Raptor. And one of the signals that we like to see on the Raptor is what we call a double pullback signal, where we essentially see two moves into the hard edge, pardon me, and then we have the market come out and generate a signal, which occurred right here. So that was a few minutes into crude oil's open this morning. Right now it looks like we might be working on another short-term pullback. So no, we don't really have a counter trend signal for the Raptor tool. We do have counter trend signals for the Hawk, the Falcon, and the Eagle. But I haven't really discovered one for the Raptor just yet. So yesterday, crude oil pretty much sideways. Oh yeah, today's inventory, isn't it? So we'll hang around for crude inventory. We'll come back and visit it around inventory report. The Raptor also has the trend change signal borrowed from the Eagle band, where the band flips over and we're looking at that first signal where everything is in sync. You can see we had fairly decent follow through there. Normally with the Raptor, what we're looking at is we're looking for opportunities to trade the market coming out of the band or bouncing off of the hard edge. You see here was another double pullback signal. This one a little bit bigger than the one I just showed you, but we get the double pullback, the market comes out. A lot of times the yellow bars alert us to signal opportunities also. Unlike the Hawk, where we pretty much ignore the yellow bars on the scalping tool, on the Raptor, the yellow bars actually tip us off that a signal is building. So you can see here we had a very early trend change signal. This is one of these signals that's easier to see in hindsight, right? It occurred right here, but if you didn't get that one, there was a proper trend change signal that developed just a little bit afterwards. But the way the Raptor is right now, it looks like I said we might have an opportunity building here. Let's shoot a trend line across the bottom, see where that falls. Oh yeah, look at that. Okay, well, we'll put that on the back burner. Come back to that in a little while. All right, well, I'm getting a bunch of scalp warnings, but once again, we need to let this market actually build into a signal that we can trade. So we had first micro macro cross here, outstanding. Almost a macro pullback, great follow through there. So I suspect we're going to see a macro pullback pretty soon. Hans is asking about the cheat sheets for the other tools. And hold on a second here. I will show you because you guys are wondering what the heck is a cheat sheet. This is the cheat sheet for the hawk. And essentially what it does is it highlights our high probability signals. So we have our first micro macro cross, we have our macro pullback, our 4-arrow consolidation, our post consolidation, and then our red bar buy, green bar sell. These are the primary signals that we focus on when we're trading. Hans is asking, do we have the cheat sheets ready for the other tools yet? Hint, hint, nudge, nudge, wink, wink. No, Hans, not yet. And I apologize. I know I've been promising them forever, and if Phil is in the room, yeah, there you are. Phil loves to give me a hard time about this. I'm busy. But I know I promised, I said I would have it by the end of February, and here we are coming up on the end of March. Yes, I will get it done. I promise. The regular trading room is taking a little bit of a break at the end of this week, so that'll free up a little bit of time. The reason you have the hawk cheat sheet and not the other ones is when DTS first launched, it seemed the hawk tool was the tool that gave people, or confused the most people, because the hawk was generating signals so frequently, because it's a scalping tool, right? So people would look at these signals and say, well, here's a signal, why don't I take this signal? Right? Here's a signal, why don't I take that? Or here's a signal, why don't I take this? Here's a signal, why don't I take that? So we had to clarify the hawk signals, because that was the one that was causing, the most confusion. The other reason, of course, is that I go over the signals with you every day in the room, like the Falcon here. You know, we go over the early trend change signal. We go over the proper trend change signal. We go over, where's the late filter entry? We probably had one yesterday. We go over the late filter entry. We go over the double dot reversal, or the double dot reversal down here. Right? Trend change signal, late filter entry, Like we go over all these over and over. So the Hawk tool or the Falcon tool and the Eagle tool and the Raptor tool shouldn't be as confusing, but yes, I know you need your cheat sheets. And Phil, you will be the first one to get it. Hans is asking, Jim has actually been very helpful. Jim is one of the DTS owners. He has been very helpful with helping identify some of the Raptor signals. I always, when I put these cheat sheets together too, I'm always asking fellow traders what signals they like. Like I know the ones that we have developed, but you know, every once in a while somebody sees something that you don't see. And like the Hawk tool, you know, there was a lot of collaboration in settling on the best signals. Yeah, Jim isn't actually involved in the indicator warehouse operation. He's just a DTS owner, and he's yes, he's been very instrumental in helping identify, especially on the Raptor. And speaking of Jim, he's given me the color commentary here. Jim's watching the advanced decline line. He says they're pretty much even up. Almost dead even. 1386 to the positive, 1344 to the negative. So a very neutral market at the moment, at least according to the advanced decline. Of course, things like advanced decline and stuff, it always depends too where you've been. I suspect the advanced decline started a little bit higher today and took a bit of a nosedive, especially given how the market fell off, right? That's huge. Something that we were kind of looking for. Yeah, Jim says it's fading big time. Okay, hold on. There were a couple questions here that I've missed, so let me just go back and make sure. Brent is asking the brick size in the Renko. Okay, now, Brent, these aren't traditional Renkos. I'll give you the brick sizes for sure, but just keep in mind if you plug these into a regular Renko bar, they're not going to work the same. But for the Hawk Scalper, for instruments trading $10 a tick or less, we recommend the following settings. It would be 6 ticks on your Hawk Scalper, 8 ticks on your Falcon Swing Trader, 10 or 12 ticks on the Eagle Trend Trader, and 8 ticks on the Raptor. Even though the brick size increases slightly from one tool to the next, I should point out that this isn't exactly the same as taking a 5-minute chart and a 15-minute chart and an hourly chart. That is a rough approximation. These tools are actually individually programmed, and there's a lot more going on behind the scenes. So the Hawk has been specifically programmed to pick up scalp signals. The Falcon specifically programmed for intermediate swing signals. The Eagle specifically programmed, of course, for trend signals. Hans is asking, is there a stop in the trading room coming? Maybe I'm going to buy a program and I need the trading room. Well, the trading room, the DTS owner trading room, yes, it is a training room and a trading room. I try to highlight promising trades, but it is also, maybe its chief function is a training room. The DTS room has been running since the beginning of the year, so this is going to be 3 months in. We're going to take a little bit of a break. We have a plethora of trading videos archived. So there's training on everything and anything. There's a lot of videos that you can access. And of course, you can always email me if you have a particular question. I can always put together a short video for you also. Okay, opening range is done, but wow, what an opening range. Wayne is asking about the pound US pair. Wayne, maybe I can show it to you on the the futures version. It will move exactly the same. Okay, while that's loading, the pound trades at 6 1/4 a tick. So it's a little bit, our settings are a little bit different for the pound. I tend to dial it down just a little bit, but if you're trading the pound or the euro, I'll give you their specific settings also. But here's the British pound on the Hawk Scalper. And let's dial it back here toward the London Open, because if you're trading the pound, you're probably going to be watching it around that time. So London opens right about here, and right out of the gate, we get a first micro-macro cross signal. Notice, very easy to identify. We get the micro line crossing the macro line. Everything comes into sync. We get the warning dot, triangle, hash mark. Very nice follow through on that one. And then right after that, we get so here's the first micro-macro cross. Right after that, we get a macro pullback signal. So we go 2 for 2. Then we hit quite a bit of choppiness. Here's actually a red bar buy signal, which, did that have any sort of trend line support to it? I'm not sure I would have, when that was actually building, I would have, well, we didn't get a test of the extreme. You know, it's easy to say in hindsight I would have bought it. A lot of times these red bar buys, it's the weakest of the signals. A lot of times I'll just use it as an early warning. In other words, if this signal pops up and then fails, well, I'll have a better idea that I'm going to be short this market, that perhaps it's reversing. But that red bar buy worked out and came right back. Now, here's something that we run into all the time. I should point this out because this is a first micro-macro cross signal. And a lot of times people will take this signal and they'll say, and it will fail, because even though it doesn't really fail, what people end up doing is they end up framing the trade very, very tight, like this. And most of the times, the nice thing about DTS is that you get immediate momentum. See here, the first micro-macro cross back here, immediate momentum. Macro pullback, immediate momentum. But here's the first micro-macro cross. But how, do you notice how different this one looks from this one? Do you see the proximity that the signal developed after the crossover versus this here? So when we generate a signal like this, where the market has kind of made a strong move higher, and now all of a sudden we're getting the first micro-macro cross, right? I would have preferred to have seen it perhaps print somewhere around here. I know there's a very real possibility that this market is going to try to retreat and perhaps give me a macro pullback signal. And this is just one of these things, after you use your tools for a week or so, you're going to identify that these types of things are going to happen. So what I would do is, even though I might take the entry there, I'm going to try to run a very deep stop. I'm either going to run it back here to the macro line or maybe even below the other swing. Now, what that does is it gives me a little bit more staying power, right? So the market brings me in, and then it starts this reversal. Okay, so now I know where the market is pivoting. If this market continues higher from here, well, now I can start bringing my stops up, right? I can start rolling my stop here, and I can even start bringing my stop up bar for bar. The idea is that if I caught myself on the wrong side of this trade, then at least I can minimize my risk or my loss. So fortunately, it did continue higher after that huge swing. But remember that trading is as much about probabilities as anything. You want to focus on high probability signals. And one of the ways you make the signal or skew the probabilities in your favor is by giving yourself a reasonable stop. Just in case, right? We didn't really see a test. Well, I suppose we could have considered this a test of the extreme here. That could have been our test of the extreme, and then the market goes. But whenever we see the market explode here on the hawk and not generate that first micro-macro cross signal early, I always feel I have to run a deeper stop, right? Just in case it's going to try to peel back on me. So let's see where we're at right now with the British pound. Okay, here just prior to the North American Open, you see we had a first micro-macro cross to the downside. A macro pullback which turned into a yellow bar, which I would have ignored, but we came right back with another first micro-macro cross signal right here. Here we had a 4-arrow consolidation. Oh, sorry. Yeah, 1, 2, 3, 4-arrow consolidation. This is a signal I will take off of a yellow bar. And coincidentally, it also turned into a green bar sell. So we got the double whammy on that one. And it also came down. So here we are, once again, yellow bars. I tend to ignore the market when it's trading in yellow bars. And you can see from that trend line I shot through earlier, we're kind of bouncing off the trend line with the pound. Quick look at the Falcon, because the NQ is in consolidation mode right now. So again, I'll dial it back to the London Open. So right about here, you did get the early trend change signal. Honestly, though, real time, that might have been a little bit tough to get. The proper trend change signal developed right here. Now, I know you're looking at it and you're thinking, oh, well, isn't that a little bit late? Well, yes and no. Remember, this is your swing trading tool. So here was our trend change signal to the upside. Another early trend change signal to the downside. Let's see how that one fits on a trend line. No, honestly, I probably would have passed on that. So here's a trend change signal to the upside once again. This one gave you a little bit of heat. So here's the trend change signal to the upside. A little bit of heat and finally goes higher. So again, an example of if the market is looking a little bit choppy to you, let me clean this up. There's no real direction here. I suppose you could say there's a slight upward bias because of the higher swing low. And you see all of a sudden we have a lower swing high. So when you take a signal like this signal right here, our trend change signal, You need to take steps to protect yourself. Perhaps dial down your risk exposure. Perhaps run, a slightly deeper stop. Maybe let's run it down here, below this little swing, or even below the swing in the trend line, just to try to give yourself a little bit of staying power. So when the market comes in, okay, now it's heading higher. Now I can start to roll my stop, right? I can start I know where the market's swinging. I can roll my stop. I can bring it up, get the trade to break even. Okay, maybe I was a little too quick there, but you get the idea, right? You want to give yourself an opportunity that you don't get stopped out immediately, or as I always say in the room, the one thing that annoys me more than anything, or even more than a losing trade sometimes, is being right but getting stopped out too early. So I could have had a profitable trade, but I actually get stopped out and I take a loss because my stop is either too tight or I'm too quick with the stop, right? So you always have to give the market a little bit of room. This is where the trade manager is so helpful too, because it controls your risk exposure. It never lets you risk more than you can afford to lose. Right, so let's take a look here at this example, because there's still not much going on in the NQ at the moment. So a good time to explain this, because this is a concept that a lot of traders are not familiar with. Okay, so here we're getting a signal. This is how most of you will set up the trade. You're going to say, oh, I'm going to be extra careful. I'm just going to run the trade like this. And what happens is the market brings you in, reverses, and now you're out, right? That's what most traders do. I'm not going to pick on you. I'm not saying you're going to do that, but that's what most people do. What should you do? Well, what if it cost you the same amount of money regardless of where you put your stop? If it cost you the same to risk it here as it does to risk it down here, which stop do you think has the greater probability of success? The greater probability of actually hitting your profit target? You think running the tight stop here or running the loose stop down here? Now remember, we're just talking probabilities. We're not talking risk reward or anything like that. We're talking probabilities. Well, intuitively, it should make sense that the bigger stop also has the higher probability. Chances that the market will hit your stop here before finding your profit target are probably pretty good, even though it looks like that's about a 2-to-1 reward to risk ratio. The chances that the market will hit your stop loss here before hitting your profit target here are probably not that strong, right? Chances are pretty good, given that we're seeing a mild uptrend of sorts. We're generating a buy signal. Chances are pretty good that the market will hit your profit target before hitting your stop loss, because you have a lot more staying power here. But you see, that's the beauty of the trade manager. Notice my risk amount, $437. What was my risk amount if I framed the trade really tight? Oh, $487, so $50 more. The trade manager is controlling the risk, only allowing me to risk 2% of my account. But notice the difference. Here, I'm trading 13 contracts, and here, I'm only trading 2 contracts. But the probability that this trade will work out is much higher. But at no time am I risking more than I can afford to lose. Right? So whereas I would have been stopped out for a $487 loss or $450 loss, depending where I placed my stop. If I tried to keep my stop kind of tight through here, I actually made $250 profit here. This is something that a lot of people never manage to wrap their heads around, is that you need to, well, A, you need to give the market some room, because unlike what happened this morning, the market never makes a straight line to where it wants to go. And B, you always control your risk, risking the same amount. So whether you frame the trade like this, $487, or whether you frame the trade like this, $412, is still in that ballpark, right? A little bit of a rounding error. It always has the same amount of risk in play. So that if the trade does reverse on you and stop you out, well, you haven't risked more than you can afford. All right, here, Eagle Trend Trader, just real quick on the British pound. Market opened, oops, sorry. Is this the right day? Is this yesterday? No, this is today. Hold on a second here. I've confused myself. Okay, here's the British pound. London open right about here. I'm not going to tell you I would have taken that red bar buy, because I probably wouldn't have. The Hawk and the Falcon picked it up. The Eagle was still in transition mode. The trend hasn't developed yet. Comes up, comes down, comes back. Okay, now here's a red bar buy I could get on board with. Comes up, flip-flops a little bit. Here's a hard edge bounce. And here we are with a red bar buy. Oh, look at that. This red bar buy failed. Pay attention, folks. This is something you're not going to see in any other trading room. A moderator actually pointing out a signal that failed. Yes, it's true. As good as DTS is, not all the signals work out 100% of the time. But this did develop into our counter trend signal, which is we call the rule of three, where we have three signals against the band. So the band is actually bullish. We're generating three counter trend signals. And that actually had a little bit of follow through to the downside. So where are we at with the pound right now? Oh, here we are. We're into the hard edge. So let's see. Let's shoot a trend line across the top here. See what the trend traders are looking at. Oh, well, we are getting a little bit of a reaction there. We might come out of this with a with trend signal. That would look like this guy right here, where everything comes into sync. So it's out of sync, come back into sync. I don't want to see the green band getting any bigger. I like to see the green band stay kind of small. If the band starts building, it's going to change the bias. See, notice here we were in a downtrend, and then the green band starts to get a little bit bigger, the red band gets a little bit smaller, and then all of a sudden we start going the other direction. So that's kind of what I'm looking at now here with the Eagle. So possibility, we're going to see a little bit of a move down here in the pound. A green bar sell would be very welcome here. That would be a good selling opportunity, which should carry some follow through. Otherwise, we might see a little bit of a reversal here in the pound. Hans is asking, how long is the trade room closed down for? Typically a month. I take a month to, well, do some of my own trading and also get caught up on these other things like cheat sheets and whatnot. And also, I've got a lot of coaching requests that I haven't been able to do, so we'll be doing some of those also. A good question here from Craig. Craig asked, can you use the same future, or can you trade the same future using different birds, meaning a long in the eagle and a long scalp in the hawk? Or do you just use the various birds to help guide you toward the high probability trades you look for? A little bit of both, actually, Craig. Like for instance, right here in the hawk, you see the eagle still very bearish. We've got a bearish band. We're trading inside the band. And then here on the hawk, we generated a first micro-macro cross buy signal, right? So this is a signal. I probably set it up something like this. Boom, 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 hit our profit target. And so we had a scalp opportunity here. But we haven't really had a buy signal just yet in the eagle. Oh, it looks like we did have a buy signal here in the falcon also. So we had a trend change signal here in the falcon, and that too has just hit our profit objective. So yes, you can. I trade each of the birds independent of one another, but a lot of times you'll get confirmation in signals. And that does lend some weight to the signal too. Those of you who have been in the trading room the last few days know that we've been struggling to get the signals lining up. We'll get, say, a buy signal in the hawk and a sell signal in the eagle, and it's like, come on, you guys, get it together. The signals that are in sync tend to have better follow through to them. They tend to have a little bit more going for them. I hope that makes sense. Yeah, okay. These blue dots here, I didn't get a chance to explain these very much, and I should put on a trade so you can see how those work. These blue dots, these are our stop strategy here on our trade manager and the Trailblazer. We have 16 different stop strategies to choose from. Each one is fully customizable. So right now I've got the ATR going. If I want to loosen it up a little bit, I can do that as well. And what these stop strategies do, they're great if you want to have a runner in play. A lot of times I'm all in, all out, but you can also set up your trade. Say I want to take 50% on target one and leave the rest in as a runner. So I could set up my trade like so. I've got 3 contracts in play. I take profit on one, and now I have a runner in play for the other 2. And what Trade Manager will do is it will manage the position according to these blue dots. So wherever those blue dots are, that's where it's going to roll my stop loss order. So you can see if I change stop strategies, I can make them more conservative or I can be more aggressive, whatever I like. So depending on how the market is behaving or how much open profit I have in a trade, sometimes I'll switch to a more aggressive stop strategy. Sometimes early out in a trade, I'll use something more conservative, say like a swing high-low strategy, where I'm covering above the last major swing point. Again, just to give the market a little bit more staying power. So that's what those blue dots are. And you can see you can turn them on and off. You can preview them if you want to say, okay, well, this is what the ATR is like. What would it be like if I had parabolics on here? So you can hit the preview button, and then it will show you where the parabolics would be at. And if you say, oh, I'd like that better, then you click accept, and now you're running a parabolic strategy for your stop loss. This Trade Manager tool is perhaps the most important piece of trading software you can own. And I'm not just saying that. This enables you to trade just like Wall Street trades. It controls your risk. It manages your trade, or it helps you manage your trade. You can automate your profit targets, or you can use manual profit targets. Whatever you choose. Very, very powerful system. This was Adam's brainchild. And there's been years of programming go into this tool. You would not believe how sophisticated this tool is and how difficult it was to program to get it to work right. The beauty of this tool too is that these orders, let's say we're long and our stop loss is right here. This order is at the exchange level. So let's say your computer fails, or you have a power outage, or let's say you even do something silly like you refresh your screen while you're in a trade. Big no-no, don't do that. And even though something may happen to your computer, your stop loss order is still at the exchange level. So let's say you had a computer failure and all of a sudden it's like, uh-oh, do I have a stop loss in place? Yes, you do. So very, very sophisticated piece of software. And I should see if we get some sort of signal going on here that I can show you how it actually rolls the stops for you. Let's see, is anybody playing nice? Might get a sell signal here. Hans is asking about the tick size for the DAX. I would go with the standard 6, 8, and 12 for the DAX. The DAX moves fast enough that you can still get some decent signals. Okay, we're getting sort of a green bar sell going on here. And I might go with the bar high-low strategy because it is faster and you can actually see it roll. So we're just getting the warning dot. I don't have the signal just yet. I can actually anticipate the signal though. I know if this bar finishes down here that I will get a sell signal. But what I can do is I can also dial down the risk amount. All right, so we're going to submit that order. We'll see if we get filled, and then you'll be able to see how it rolls the stops in. And I'm going to address Hans's question here. Hans asks, but if you run a big stop, but if your big stop is being hit, you ruin a lot of small or smaller profits. Yes, that is true. It is a balancing act. Okay. While we're waiting for this trade, which looks like it might hit here in a sec. Okay, there we go. So hopefully this bar will finish lower and you'll be able to see how it rolls the stops in. Come on, get down there. Oh, and it looks like I missed crude inventory. Oh, nuts. Oh, well. Come on, get down there, NQ. If there's two things, okay, it's not even going to allow me to demonstrate this for you. If there's two things that most traders do wrong, and you can write these down, two things that most traders do wrong. They run their stops too tight. That's number one. And they take too many trades. That's number two. Most people think that in order to make more money trading, you need to trade more, right? It makes sense. After all, if I was working on a factory floor, if I can produce more widgets and I'm not working on an hourly basis, if I can produce more widgets than the next guy, I make more money, right? Well, that's fine in the brick and mortar world, but in the trading world, sometimes it has the exact opposite effect, where if you trade more, you actually earn less. Wall Street, of course, they trade, and Wall Street is not in the business of speculation. Don't ever kid yourself. Wall Street is in the business of making money. They make billions of dollars a year. How do they do that? Well, they trade for exceptionally tight profit targets. They trade for quarter points, or actually if they're trading stocks, they actually trade for what they call teenies, which is a 16th. We can't do that. Not usually, because we don't have access to the information they have. We don't have the order fulfillment that they have. But if you're only trading for a 16th, well, why would you trade for a 16th, first of all? Why would you even be bothered trading for a tick? Well, you would trade for a tick first because it's an exceptionally high probability that you will get that tick. Some of you will have heard me say this before, but do you know how, I can tell you right now, a system that produces 98.5% of the time. 98.5% of the time you will be right. Trading the E-mini S&P. How do you do that? Trade for a tick. Trade for a single tick on the E-mini S&P. And 98.5% of the time the market will move one tick in your favor. So almost 100% of the time. The other thing Wall Street does is, even though they're only trading for a teeny, they go in with huge volume. Not so much that they actually slip the market. But Wall Street, of course, has to do this several times a day because of the volume they trade. But they go in and they'll trade volume that makes it worth their while. So this is what we're trying to replicate here. When we get a high probability signal, I can't guarantee that the signal will work 100% of the time. But when I see something like a green bar sell bouncing off of the hard edge on the eagle, I know that's a high probability signal. So ideally what I want to do, and I'm already in this trade so I can't set it up again, but what I want to do is I want to go in and say, all right, I can risk 2% of my account. That's my ante, similar to playing cards, right? I'm going to ante up. I'm going to risk 2% of my account. Here I'm risking 1%, $140. If the trade goes sideways and I lose $140, yes, it's unpleasant. No, it's not going to ruin me. For you, it might be different. For you, 1 or 2% of your account might be more or less. I worked with a fellow, he was trading a $300,000 account. We were only trading 0.25% of his account because that's all he had to risk. Okay, so what's the other thing Wall Street does? Okay, so they trade high probability trades. They go in with size, and last, they control their frequency. Wall Street, believe it or not, Wall Street traders, they pick and choose their moments. They might wait all day for the best signal. Now, they dumped the market this morning, and I think everybody and their uncle, or almost everybody and their uncle, knew that the NQ was going to spin off this morning. I was looking for it. If you look at a daily chart, it seems fairly obvious. But regardless, they picked their moment. The market opened, they dumped their stock, down comes the NQ. Wall Street's probably done. And here we are, right? Us pikers trying to pick up another trade. Well, if you're losing money trading, I'll bet you dollars to donuts you're probably over trading. Do you know how many trades I take in a day? In a day, when I'm trading for real? 2, maybe 3. Okay, there you go. Did you see the trade manager roll the stop from up here down here? So you see it's totally automated. I don't even have to watch it anymore. The beauty of this, of course, is now I can look at other opportunities, which was the point I was trying to make with Trade Manager. Now I have Trade Manager managing the trade according to my stop strategy that I selected. I can look for other opportunities. I can say, oh, look, here on the Falcon, here's a early trend change signal. Maybe I want to get on board there, right? So I can set up for an early trend change signal. I can risk it up here. I can say, okay, well, maybe I want to run a slightly looser stop. Oop, that one's not going to work. Maybe we'll go with the swing strategy. So that puts that up there. Or even if I want to run it looser still, I can disable the stops entirely. And I can say, all right, well, I'll short it here and I want to run my stop way up here. Okay, let's do that. Is this trade going to work out? Well, it might not. If the trade does not work out, I have not lost more than I can afford to lose, right? But I've given myself an opportunity now. But like I was saying, Wall Street, they work on high probability trades. They work on high probability targets. In other words, they don't get greedy. Big, big lesson there. They trade with size, or as much as they can afford, and they control their frequency. So if you want to make money, well, Wall Street's making money, then you have to trade like Wall Street, right? So be selective about your signals. If I know I'm only going to take 2 signals a day, and do you think I'm going to be chasing every single signal? You think if I'm looking at a signal like this in the hawk off of a yellow bar, do you think I'm thinking, gee, maybe I should buy that? No. No, I'm not thinking that. I'm thinking, all right, let's see what happens next. Let's see if a downtrend develops out of this. I'll get a first micro-macro cross lower. Here was the first micro-macro cross here. High probability signal. There's always opportunities. And if I know I'm only going to take 2 trades a day, I can be choosy. I can afford to be choosy. I'll put my soapbox away now. Hans is asking, Hans is full of good questions. I'm glad Hans is here on Wednesdays. Oh, by the way, we will still have the public trading open house on Wednesdays, even though the room will be closed for much of the week. See, our stop still rolling down, and I can force the trade to break even also. See, I can hit the break even, automatically forces the trade to break even. Did we just hit our profit target? Oh, we did too. We hit our profit target here on the Falcon, on our early trend change signal. So Hans is asking, is the best you can do always waiting for a pullback? Yes and no. Like I said, we're kind of focusing on the signal setup. So here we have a trend change signal, right? As soon as this trend line changes color on the Falcon, I'm thinking, okay, where's my signal? Well, here's my up, my trend line changed color. Here's my down. Look, it was only a single bar down. Here's my up. Here's my signal. So I think, okay, well, there's my signal. How am I going to do this trade now? Let's roll this over. We'll pretend it's real time. Okay, so my trend line has changed color. I've got my up, down, up pattern. In fact, I could have even taken it here, but let's say I take it from here. So how am I going to structure my trade now? Am I going to run my stop right here, knowing that it's going to cost me the same if I'm using my risk manager as running my stop all the way down here? Well, I'm probably better off running my stop down here, don't you think? Because if this trade reverses on me now and takes me out below the lows, then I can say with confidence, yeah, I'm on the wrong side of this trade. Time to get out. Time to take my lumps. So here we go. They bring us in, a little bit of heat, and there they go, hit our profit target. I don't even need to worry about it. So what have I done? I've been selective about my trade. I've picked a high probability signal. I went in with size as much as I could afford. I traded 2 contracts. What else did I do? I controlled the frequency of my trade. That again is tied in with choosing the higher probability signal. And I ran a high probability profit target. So I've got my money. This essentially is counter trend, right? So all the more reason to go all in, all out. I wouldn't expect this market to explode to the upside. So I take my high probability target and look at that. A few bars later, the market starts to reverse. And now they come back with another trend change signal. It's like, oh, another trend change signal. I know this is an early trend change signal, right? I got my little up, down, down, up, down pattern. I know the market's in the downtrend, no question there. So am I opposed to taking an early trend change signal with trend? No, that doesn't look too bad. So there's my signal. Once again, I can run my stop right above this little swing high, or maybe I want to go above the primary support line. What am I doing? I'm taking a high probability signal. I'm running a high probability profit target. I'm controlling my exposure or maximizing my exposure. In this case, I can only get 1 contract off, but I'm controlling my risk. And down comes the market, and voila, another profitable trade. And that's how you do it. If I were, if this were my own account, I would probably call it a day right now. So what did I make on the one? $200 and another $100 on this one. I might take one more trade. But really, $300 for half an hour's work, and I'm using air quotes, work. That's not bad. You're going to have now, of course, this should have been a 4-figure day, because ideally we would have sold this one up here, right? There's our green bar sell. We could have put a runner in here, or we could have taken it across all 3 birds. This is a 4-figure day today. And you can see even here, $400 just on the eagle alone. But these are the kinds of the kinds of things that you're looking for. These are the kinds of days. Oh, we hit our profit objective here too. Yeah, look at that. So between the Eagle and the Falcon, I would have had, there's 300, I would have had $400 just in the span of about a half an hour. Now, not every day is that way. I'm not going to tell you every single day is like that. Anybody who's been in the trading room this last week knows that, you know, earlier in the week, where are you? I'm not going to make you guys dizzy there. Earlier in the week, it's been a struggle. Oh my gosh, it's been a struggle. The market just not cooperating. We've been waiting for the market to get outside of these ranges that it's building. And sometimes, you know, I'll demo stuff in the trading room, but sometimes we won't have a tradable signal for the morning session. At least not in the NASDAQ. Sometimes we'll pick something up in crude oil. But you get the point. You need to be picky. Hans is asking the Raptor, what is the tick size for the DAX? It would also be the standard. It would be 8 ticks. Oh, Craig, you're going to get me going here. Okay, first, Wayne is asking about the British pound. And hold on, I threw the soybean market back on. He's asking, the British pound looks like it might be a trend change. So let's take a look at what's going on here with the pound. And I'm sorry, it's probably already moved by the time I've gotten to your question. Here's the Eagle. So this is where we were looking at the pound earlier. And it came back with a trend signal. See right here. There you go. Everything is in sync with trend signal. That is a sellable signal right there. And you could either cover above that swing high or above this swing high. And have we reached our profit objective yet? Oh, almost. Almost there. Okay. All right, I'll deal with Wayne's question here and then I'll get to Craig because Craig's question is going to take me a little while. Wayne is saying, if you look back at around 1010 on the British pound, all right, what time zone are you in, Wayne? Okay, we're gonna say, okay, New York time, so 7:10 my time. Thank you. I'm on the West Coast. Okay, so I think this is the signal here that Wayne's asking about. This signal right here. Okay, so Wayne is asking, if you could look back at around 1010 on the British pound, what would have been your indication for direction near the trend line? Okay. A lot of times I'll throw trend lines on just to help me see what other traders are seeing. You know, there's no denying that there's a lot of trend traders in the market. So if I shoot a trend line across the highs like this and I see my tool come back to the trend line and now come out of the trend line, I'm producing a warning dot, which tells me a trade is developing. And then when all the trade parameters are met, I have a triangle and a hash mark print. So that tells me that I have a tradable signal. Now it's up to me to decide, well, do I want to take the signal? How do I want to structure the trade? How much do I want to risk? And so on and so forth. So I've got my ATR line. That's this blue squiggly red and blue line here. Normally I enter on the other side of the ATR line. It's just a little bit of an added filter. Now I need to decide where am I going to place my stop. Am I going to place my stop above here or above here, or maybe somewhere in between? Am I going to use, there's some evidence that I could probably run a stop halfway. So let's say I choose to run my stop like that. Then this is my trade. But what generates my signal? Well, the system is producing a warning dot, a triangle, and a hash mark. And it just gives me a little added confidence that it's actually signaling off of the trend line. Now, if I wasn't as confident with the trade, if for whatever reason it wasn't looking as promising to me, I would probably dial down the risk amount for starters. So rather than risk 2%, I would risk 1% of my account, and maybe I'd run my stop up here. So I'm still in the trade. If the market, if the market takes off, I'm still in the trade. But if the trade goes against me and stops me out, well, I've only lost 1% of my account. Right? If you're trading a $10,000 account, it's like losing $100. It's not going to ruin you. So that's, it's a combination not just of the signal, but also how are you going to manage your trade? How are you going to manage your exposure? And I suppose that's one of the reasons why trading is a little bit more difficult too, because so many people think it's just the signal. They think, and if this has ever happened to you, and I'm sure it's had, where you have a few days where everything is just going off without a hitch, and you're saying, oh, this is great, I finally figured this out, and then all of a sudden you can't buy a winning trade. What's changed? You're still using the same signal, right? What's changed? Well, the market environment has changed, but you didn't know it changed. That's why we have 3 different tools. So that when the market is in a scalping environment, I use my scalping tool. When the market is in a swinging environment, I use my swing trade tool. And when it's in a trending environment, I use my trend trading tool. And by the way, while I'm speaking of that, here's a little add-on tool. This is called the Trade Forecaster. And it tries to forecast what your market environment will be. So currently we're in scalp mode, probably for about another 10 minutes, and then we're going to move into a trend environment. But if you're using the same tool, regardless of the market condition, it's like my grandfather always used to say, if the only tool you have is a hammer, you tend to see every problem as a nail. Right? You're trying to use the same tool, even though you may have a screw in front of you instead of a nail. Sure, a hammer will work on a screw, but it doesn't work as well as a screwdriver. You get my point. All right. Oh yeah, Wayne, I know. Wayne says I have Trade Manager, and so far I love it. It does for me what I've been doing with spreadsheets for taking trades. Yeah, Wayne says the Trade Manager, it controls your position size. It never, the way I like to explain Trade Manager is it never overcapitalizes a losing trade or undercapitalizes a winning trade. So you're always going to be correctly capitalized. If the trade goes south, okay, you didn't lose more than you could afford. But if the trade wins, you've maximized your earnings. You've all heard it, cut your losses short, let your profits run. How do you do that? Well, this is one way you do that. It's not just let the market, catch a rocket ship market like this. How often does this happen? Couple, 3 times a month? and you don't always know when the bottom's going to fall out or when the market's going to take off like a rocket ship. Most of the time, trading is like this, right? You got little moves up, little moves down. Okay, here's a macro pullback signal that we have brewing. Well, I wanted to make sure I get to Craig's question, though, before we run out of time, because I've got a 9 o'clock appointment, and I'm afraid we're going to have to close up the room a little early today. Okay, Craig asked, and some of you are going to roll your eyes because you know I can get off on a tangent when it comes to risk-reward ratios. Craig is asking, I was always taught to look for 1 to 3 risk to reward, meaning risk $100 to make $300. However, I do agree with your stops, and this is one of my issues. Can you provide your thoughts on your trading? Personally, I believe that risk-reward ratios is the biggest lie ever told to the trading public. Yes, you can quote me on that. And I get into some, well, I don't want to say heated discussions, but some people get very upset at me for this. The reason is risk-reward ratios work perfectly on paper. They're perfect on paper, right? It makes perfect sense. Well, I'm only going to risk $100 and I'm going to make $300. Do you know how professional traders use risk-reward ratios? They use them in hindsight. They say after the fact, oh, okay, well, we made $300 on this one and we only had $100 in risk. After the fact, oh, we made $1,000 on this one and we only had $300 in risk. After the fact. The problem with risk-reward ratios is twofold. Here, let me go back to the eagle because it's going to be a little bit better to clarify this. The problem with risk-reward ratios is twofold. First problem is if you're only looking at risk-reward ratios, okay. The problem with risk-reward ratios is that you base a trade, no trade decision entirely on the reward side of the equation, right? Everything is in relation to reward. But what is one part of the trade equation that you don't know, that you don't have the answer to? Yes, that's right, the reward side. You haven't, nobody, I don't care who you are. I don't care whether you're Warren Buffett. I don't care whether you are Paul Tudor Jones. I don't care who you are. You do not know where the market is going next. You might have a guess, and quite honestly, your guess is as good as mine, right? It's a 50-50 proposition. But you cannot tell me with any degree of certainty where the market will go to next. So here's the problem with risk-reward ratios. We get a signal. We have support. How are you going to generate a 3-to-1 risk-reward ratio here? Right? It's going to end up looking something like this. You're going to say, oh, okay, hold on a second here. I've got to put my entry, I've got my entry here, 1, 2, 3. I'm going to have to run my stop loss right there to get my profit right down here. Right? So here's my 3-to-1 risk-reward ratio in order to capitalize on this trade. And you're looking at this and you're saying, oh, well, $40, I'm going to get tagged there. You know you're going to get tagged. So you say, well, okay, what if I do this? What if I run my stop up here and I run my stop down here? Oh, shoot, I can't do that. I'm risking twice as much money as I'm earning, right? So what do? I'm going to have to pass on the trade. And what happens? Boom. And all the time you're kicking yourself around the block saying, why didn't I take that trade? Well, you didn't take the trade because the risk-reward ratio wasn't right. and you couldn't manufacture a risk-reward ratio that wouldn't stop you out first. That's the biggest problem with risk-reward ratios, is they only look at the reward side. Nobody knows the reward side. And I totally agree with everybody that on paper they make sense 100% of the time. But when you use them in real life, they don't work very well. What works better for you are probabilities, looking for high probability signals. You know, regardless of what your system is, whether you're using DTS, whether you're using, I don't know, Bollinger Bands or MACD crossovers or whatever you're using. If you found a signal that has a high probability signal, do yourself a favor, wait for the signal. Go in with as much size as you can afford. Go with a high probability profit target. These are all things that almost guarantee that you will make money trading. Yes, it's true. I had a very interesting meeting with somebody the other day. This person is a professional day trader, and as you know, day traders, it's a lonely business. We don't hook up very much. I didn't even know this person was a day trader. I was meeting them for a different reason. And but I could tell from their stuff that they were obviously traders, and we got talking about trading and whatnot. And this person said to me, day trading is easy. And I laughed because it can be easy, but so many people make it so difficult. And he said, it's easy, you just don't be greedy. You know, I asked him what his average profit on a trade was. His average profit on a trade was anywhere from $50 to $200. And I know some of you are sitting there thinking, oh man, I can't make a living on $50 or $200. Do you know how much money he made while I was sitting there with him? He made $1,000 with his nickel and dime $50 and $200 trades. Now all of a sudden I can see you guys sitting a little straighter in your chairs. So that was his big piece of advice. Don't be greedy. All right, and that's probably a good place for us to end this session, because I'm sorry, I really do need to go. I just want to make sure I'm not missing anybody's important question. Joe said, an aha moment. Well, yes, Wayne says that's more than 2 or 3 trades a day too. But that was his particular trading methodology. He was trading the stock market. He was following, I think, 7 different stocks, and he took profit on 5 of them. All right, you guys. Thank you so much for your attendance today. DTS owners, I will see you in the room again tomorrow morning, bright and early. Hopefully the market will continue to be responsive like this. If you are trading this afternoon, I think we're going to see a little bit of a pullback. I think we might see some profit taking here, although big picture, I still expect the NQ and the stock indices to move a little bit lower. Crude oil pretty much recovering all the gains that it gave back off of the crude oil inventory. Soybeans still in a decline, so if you're following the soybean market, might be an opportunity there. All right, you guys, thank you again for your time and your attendance. I will see you tomorrow. Bye for now.